Harold Fenwick spent 38 years working as a millwright in Saskatchewan. He contributed to CPP every single year of his working life. He waited for his OAS at 65. He applied for GIS because his retirement income from CPP and a small workplace pension sat just below the eligibility threshold. He owned his home outright, a modest bungalow in Moose Jaw he had purchased in 1985 and lived in continuously for 39 years until he sold it in the spring of 2023 to move into a smaller condo closer to his daughter. His real estate agent told him the sale was completely tax-free because he had lived there his whole life. His accountant at the time confirmed there was no tax owing and filed his return accordingly. Both of them were correct, that he owed nothing. What neither of them told him was that the CRA Principal Residence Designation Rule requires a specific declaration to be filed every single time, even when the exemption applies in full, even when zero tax is owed, even after 39 years in the same home. In January of 2026, Harold received a letter from CRA. It was an income verification review. Not because he had done anything fraudulent, not because he owed money on the sale itself, because the formal designation had never been properly filed and the CRA's new property transaction matching system had flagged the gap. That single missing filing triggered a review that touched his GIS, created uncertainty around his OAS, and took him 5 months to resolve. Nobody warned Harold. Not Service Canada, not the CRA, nobody. And if you are a Canadian senior who owns or has ever sold a home, what happened to Harold is happening right now in 2026 to homeowners across every province. And most of them have no idea their file is at risk. Before I walk you through exactly what this principal residence rule is, why CRA is enforcing it aggressively in 2026, and what it means for your CPP, OAS, and GIS. One quick thing. The next major CPP and OAS payment date is approaching at the end of this month, and Service Canada will not send you a personal explanation connecting your home filing history to your benefit amounts. CRA will not call to remind you. Nobody is going to reach out proactively. This channel exists specifically to connect the dots between what the government quietly enforces and what it actually does to your monthly income. So if you are not subscribed yet, please subscribe right now and turn on notifications, because the senior who catches this before a review letter arrives is in a completely different position than the senior who finds out when a payment changes. Subscribe now so this information reaches you before it affects your money. Now let me show you exactly what is happening. The principal residence designation requirement that caught Harold off guard has technically existed in Canadian tax law for decades, but the formal filing obligation was significantly tightened in 2016, and that is the first thing every Canadian senior needs to understand clearly. This is not a brand new law invented in 2026. What changed permanently in 2016 is that CRA began requiring every Canadian who sells a property that qualifies, in whole or in part, as a principal residence, to report that disposition on Schedule 3 of their T1 income tax return, and to file Form T-2091 to formally designate which years the property qualified as the principal residence. This requirement applies regardless of whether any tax is owed. It applies to a senior who lived in one home their entire adult life just as much as it applies to someone who owned multiple properties. The CRA confirms this requirement on canada.ca and in its official guide RC 4169 covering the principal residence exemption. It has been the law since the 2016 tax year. The problem is that for years, CRA's enforcement of this filing requirement was inconsistent, and an enormous number of real estate agents and even some accountants told clients that because no tax was owed, no special form was needed. That advice was wrong, and in 2026, it is becoming an expensive mistake for thousands of Canadian seniors. Here is why this year specifically is different from every year since 2016. Beginning this year, the federal government implemented enhanced third-party reporting requirements for real estate transactions. Financial institutions, legal professionals handling closings, and provincial land title offices are now required to transmit transaction-level data to CRA on a more comprehensive and more rapid basis than before. According to CRA's own compliance communications, This enhanced data matching allows the agency to cross-reference reported property sales against the tax returns filed for that same year far more efficiently than in previous years. When CRA's system detects a property sale on record with no corresponding Schedule 3 entry or no T-2091 designation, a flag is automatically created on the taxpayer's file. CRA has publicly stated in its compliance priorities that unreported or improperly documented principal residence dispositions remain one of the agency's top focus areas heading into this tax year. Statistics Canada reports that more than 9 million Canadians are aged 60 and over, and a substantial share of that population sold or downsized a home during the period of elevated real estate activity between 2020 and 2023. Most of those seniors were told the sale was simply tax-free, and most of them never heard the words Schedule 3 or Form T-2091 from anyone involved in the transaction. This matters enormously for Canadian seniors receiving CPP, OAS, and GIS, because a flagged file does not stay isolated to your income tax return. It reaches directly into how Service Canada views your income, and that connection is the part almost nobody explains. The first thing every Canadian senior needs to understand in detail is what actually happens once that flag is created on your CRA file. When CRA's system identifies a property sale with no corresponding principal residence declaration, the file is not immediately assessed as fully taxable. Instead, an income verification review is opened. During that review period, CRA may provisionally treat a portion of the gain as unverified income pending your response and documentation. This provisional treatment is not a final tax assessment, but it can appear as additional reported income in CRA's system while the review is open, and that provisional figure is exactly what creates the chain reaction into your benefits. The Income Tax Act allows the principal residence exemption to eliminate capital gains tax entirely when a property qualified as your principal residence for every year of ownership, which is confirmed in Section 40 of the Act and detailed in CRA's RC 4169 guide. For a senior like Harold, who lived in one home for 39 consecutive years, the exemption, once properly filed, eliminates 100% of any gain. But until the T-2091 designation and Schedule 3 entry are received and processed, the file remains in an unresolved state, and an unresolved state, with a provisional income figure attached, is treated differently by Service Canada than a fully reconciled tax return. The second element where most Canadian seniors get completely caught off guard involves a detail that catches even homeowners who already know about Schedule 3. The full principal residence exemption is not automatic for every square foot of every property for every year of ownership. The exemption applies specifically to the years and to the portion of the property that you, your spouse, or your child ordinarily inhabited as a main home. If at any point you rented out a portion of your home, even informally, even for a short period, even just renting a basement suite to a tenant to help with retirement income, CRA's guidance confirms that a proportional share of the gain attributable to that rental use may not qualify for the exemption. The same applies if you claimed home office expenses against business income for a portion of your house, or if you owned a secondary property such as a cottage and designated it as your principal residence for certain years, which then reduces the number of years your main home can claim the exemption. CRA updated its public guidance to clarify that even informal or short-term rental arrangements, including listing a room on an online short-term rental platform for a portion of the year, can trigger this partial use calculation. Many seniors who rented a basement to a student, hosted a long-term boarder, or briefly listed a spare room never considered that this could affect their principal residence exemption decades later when they sold the home. The third point, and this is where the connection to your monthly government benefits becomes direct and immediate, involves exactly how GIS responds to any income figure that appears on your file, provisional or final. GIS is an income-tested benefit calculated using your net income from the prior year's tax return. And Service Canada's own published rate tables confirm that the maximum GIS for a single senior is currently approximately $1,065 per month. The average GIS recipient receives considerably less than that maximum, because most seniors have some other income, and GIS is reduced by 50 cents for every dollar of net income above the annual exemption threshold. Here is the calculation that almost nobody walks seniors through. If a provisional or reassessed income figure of $10,000 appears on your file because of an unresolved principal residence flag, your GIS entitlement for the following payment year can drop by approximately $5,000 annually, which works out to more than $400 less every single month. That reduction is not limited to one payment. It continues for the full benefit year until the income figure is corrected and your file is reconciled. Canadians who work with retirement income advisors and accountants who specialize in senior clients already know to file Schedule 3 and T-2091 the moment a home sale closes, specifically to prevent any provisional figure from ever touching the GIS calculation. Most Canadian seniors on CPP and OAS only discover this connection exists when a GIS deposit arrives smaller than expected, with no clear explanation attached. Now, you know before that happens to you. Now here is the connection that most coverage on this topic completely misses, and it is the reason this single filing gap is so much more serious than people assume. This is not simply a tax paperwork issue. It is a cross-program trap that can touch CPP, OAS, and GIS simultaneously through one continuous chain reaction. It begins when CRA's data matching system flags your file for a missing Schedule 3, or T-2091. That flag opens an income verification review. The review generates a provisional income entry attached to your tax record. Service Canada draws directly from CRA income data to calculate your GIS entitlement. So that provisional entry flows into the GIS calculation, and your monthly supplement is reduced, or in some cases suspended entirely, while the review remains open. Because GIS and OAS are administered together as a combined benefit stream, an open income review can also place your OAS file under a parallel review, and if the provisional income figure is large enough, it edges your file closer to the OAS recovery tax threshold, which for the current year sits at approximately $95,323 in net income. Most GIS recipients are far below that threshold under normal circumstances. But a large unresolved capital gain sitting provisionally on a file changes that picture in a way nobody anticipates. Your CPP continues to be paid as scheduled throughout this entire process because CPP is not income tested and does not draw on this same income verification mechanism. But your total monthly retirement income from all three programs combined drops because GIS and potentially OAS are affected while CPP alone remains unchanged. One missing form. 3 programs touched. A chain reaction that, once started, often takes many months to fully unwind. Harold eventually resolved his situation after contacting CRA directly and working with a tax preparer to file the outstanding Form T-2091, covering all 39 years of his ownership, along with the Schedule 3 entry for the 2023 disposition. CRA confirmed the full exemption applied and that he owed no tax, exactly as his original accountant had said. But the review took just over 5 months from the date of the letter to final resolution, and during 3 of those months, his GIS payment arrived nearly $300 lower than usual because of the provisional income figure sitting on his file. He eventually received a retroactive correction for the underpaid months, but it took additional phone calls and nearly 6 weeks longer than the original review to process that correction separately. If Harold had filed the T-2091 and Schedule 3 at the time of the actual sale in 2023, none of this would have happened at all. Here is exactly what you need to do this week. Step 1. Log into your CRA My Account at canada.ca and review your tax return history for any year in which you sold a property that was ever your home, even partially, even for part of the ownership period. Check specifically whether Schedule 3 shows a principal residence disposition for that year and whether Form T-2091 was filed alongside it. Check your CRA secure messages for any notice of review or request for information. If you find anything flagged or missing, call CRA directly at 1-800-387-1193 this week and ask explicitly whether a principal residence designation is outstanding on your file. Step 2. Log into your My Service Canada account at canada.ca and compare your most recent GIS and OAS payment amounts to what you received 6 to 12 months ago. If you notice an unexplained reduction, that may be connected to an income figure flowing in from an unresolved CRA review, rather than any error on Service Canada's side. Confirm your mailing address is current as well, since review correspondence sent to an old address may never reach you. Step 3. If you sold any home, cottage, or secondary property after 2016, and you are not completely certain that Schedule 3 and Form T 2091 were filed correctly at the time, speak with a tax professional this week rather than waiting. Late filing of this designation is often still possible, and addressing it before CRA opens a formal review puts you in a meaningfully stronger position than responding after a reassessment has already been issued. If cost is a concern, the Community Volunteer Income Tax Program offers free assistance specifically suited to situations like this one at 1-800-959-8281. One important warning before we close. Seniors dealing with CRA reviews are a frequent target for scammers right now. If you receive a call claiming to be from CRA or Service Canada stating that your home sale has triggered a penalty and that immediate payment is required to protect your CPP or OAS, hang up immediately. The CRA will never demand immediate payment by phone and will never ask for payment by gift card, wire transfer, or cryptocurrency. Legitimate CRA correspondence arrives by mail or through your secure CRA My Account messages, never as an urgent, unsolicited phone demand. Report any suspicious call to the Canadian Anti-Fraud Centre at 1-888-495-8501. Now I want to hear from you directly. If you have sold a home since 2016, did anyone involved in that sale, your real estate agent, your lawyer, or your accountant, specifically mention Schedule 3 or Form T 2091 to you at the time? And do you think the government does enough to make Canadian seniors aware of this filing requirement before it becomes a problem years later? Drop your province in the comments below. I read every one of them, and your answer may help another senior watching this video realize exactly what they need to check this week. What we covered today is confirmed and currently in effect. CRA's enhanced real estate transaction matching is already running this year, and Canadian seniors with unfiled principal residence designations from past home sales are squarely within its focus. The next CPP and OAS payment date is approaching, and Service Canada will not send you a personal warning connecting your filing history to your benefit amount. Subscribe now so that information like this reaches you before the next deadline affects your payment. You spent your entire working life contributing to this country. You paid into CPP for decades. You earned every dollar of these benefits. Go check your CRA account today, and I will see you in the next one. Take care of yourself.